Welcome to NewsNectar, your go-to source for unpacking the complex world of finance. Today we're taking a closer look at how President Trump's proposed 2025 tariffs could potentially shake up retail investor portfolios. It's a topic that's got everyone talking, from Wall Street to Main Street, and we're here to break it all down for you. In the next few minutes, we're going to cover 5 crucial areas. First, we'll look at the sector-specific impact of what some are calling the $660 billion consumer tax. We'll ask, which industries are going to feel the pinch the most? Then we'll explore defensive portfolio strategies for weathering the storm. Where should you park your money to stay safe? After that, we'll take a quick history lesson, comparing today's situation to the trade war of 2018 and even further back to the Smoot-Hawley tariffs of the 1930s. Can the past give us clues? Clues about the future? Next up, contrarian opportunities. Are there any undervalued assets out there just waiting to be discovered amidst the chaos? And finally, we'll analyze the Federal Reserve's policy outlook and what it means for the markets. Will the Fed step in, and if so, how? Adrian, which sectors are feeling the biggest hit from these tariffs? Help us understand where the pain is concentrated.
Sure, Alex. I think it's helpful to look at this in terms of direct and indirect effects. Directly, we're seeing 3 key areas taking the brunt of it right now. First point, the automotive industry. We're talking about almost $500 billion in vehicles and parts imported just last year. These tariffs could add thousands to the price of an imported car. Second point, tech hardware. Computers, semiconductors, all those accessories, plus cell phones. A huge chunk of that comes from overseas. And these tariffs? They hit those tech giants especially hard since they rely so heavily on Asian supply chains. Third is pharmaceuticals. We're talking about hundreds of billions in imported pharmaceuticals and medical inputs. These tariffs, they're going to drive up costs for drug ingredients, pressuring margins for pharma companies, and ultimately, potentially hitting consumers with higher prices.
Totally. And from a portfolio perspective, what we're really watching for is earnings revisions. Are analysts starting to downgrade their profit forecasts for these companies? We're already seeing that happen, especially in tech. You start to factor in higher input costs and potential retaliation from other countries, and it's not a pretty picture. That's why we're telling our clients to really take a close look at their exposure in those sectors.
Good color. All right, so it sounds like autos, tech, and pharma are the initial hotspots, with potential ripple effects throughout the broader market. Marcus, if I need to shore up my portfolio, where do I start? What are some defensive moves I can make right now?
Okay, Alex, there are a few key strategies we're recommending to our clients. It really depends on your risk tolerance and investment goals, but let me lay out a few options. One approach is to tilt towards low volatility and quality ETFs. These ETFs, they focus on companies with stable earnings, strong balance sheets. They tend to hold up better during market turmoil. Think of them as the steady eddies in a storm. Another option is international diversification. Historically, international markets, they often outperform the U.S. during periods of trade turmoil. Europe and China, for example, they've been leaning into fiscal stimulus to offset the impact of tariffs. And the valuations in many international markets are just more attractive than U.S. stocks right now. So it gives you a bit of a cushion. But honestly, the one that I'm really liking now are short-term tips. Now hear me out, Alex. We're talking Treasury inflation-protected securities. Ultra-short tips. These bonds, they adjust their principal with inflation, protecting your purchasing power. With all this tariff talk stoking inflation fears, tips are looking pretty good.
And Alex, something that Marcus touched on just now about international diversification, but there's a real divergence going on in global markets. The U.S. is facing a unique set of challenges right now. Tariffs, policy uncertainty, potential economic slowdown. Other regions, they're responding differently. Europe is implementing stimulus. China is trying to manage its own slowdown. So, diversifying internationally, it's not just about finding cheaper valuations. It's also about, hedging your bets against different policy responses.
That makes sense. So low-vol stocks, international exposure, tips. Got it. Coming up next, we'll rewind through history to see what past trade wars can teach us about navigating this current situation. Okay, so we've talked about the immediate impact and some defensive strategies. But this isn't the first time we've been here. Let's rewind to 2018, and then even further back to 19th. Adrian, what can we learn from history?
Absolutely, Alex. To really understand the potential impact of these tariffs, we've got to look back at similar situations, right? So 2018, Trump's first big trade war, China. What happened? The markets experienced a ton of volatility. Cyclical sectors? They really suffered. We saw these brief, sharp sell-offs every time tensions escalated. And here's the kicker. The tariffs, they didn't even deliver on their promises. Remember, the idea was to boost U.S. manufacturing? Well, it didn't happen. By the end of 2019, manufacturing output was actually lower than before the tariffs. So lesson 1, tariffs are not necessarily a magic bullet for the economy. In fact, supply chains, they just shifted around. Chinese exports, they rerouted through Vietnam, other countries. U.S. companies, they faced higher input costs. So really all it did was hurt folks.
And Alex, when we look at the Smoot-Hawley tariffs in 1930, it was a completely different scale. I mean, the Trump tariffs, they're significant. But Smoot-Hawley? That was just a disaster. We're talking the highest U.S. tariff rates in almost a century. It was just brutal. Other nations retaliated. Global trade collapsed. Economists pretty much universally agree that Smoot-Hawley weakened the economy and just exacerbated the Great Depression. Now, the key difference, Alex, is that the macro backdrop is completely different now. Today's economy, while it's cooling, it's not in a depression. Unemployment is low. Policymakers, they have more tools at their disposal. So, we're probably not headed for another Great Depression. But still, it's a cautionary tale. These broad-based tariffs, they can have really, really long-lasting negative effects on corporate earnings and economic growth. We need to keep that in mind.
Okay, so history provides some context, but also a warning. Speaking of which, it looks like we should take a contrarian approach and see what opportunities are available. Up next on Tariffs, contrarian opportunities, yeah, boss. Small caps versus mega caps. So it's not all doom and gloom, right, guys? Even with these tariff headwinds, there are always opportunities for savvy investors. We are seeing some gaps created by these policies. Marcus, small caps versus mega caps, what's the opportunity there?
Okay, so Alex, you've got to remember, the market of 2023 was just dominated by the Magnificent 7 mega caps, right? They drove just crazy valuations. But now, things are shifting a little bit. And here's where it gets interesting. Small cap stocks, they've been lagging, and now they're really, really cheap relative to those big guys. The tariff turmoil, it's kind of flipped that market momentum. The Mag 7, they're stumbling a bit, and smaller caps, they're starting to catch a bid. I mean, you look at the valuation spreads. U.S. small caps trading at a 25% discount to large caps on a forward PE basis. That's huge, man. You've got to consider playing them. That's really, really cheap. The last time small caps were this cheap versus big caps? 2001, and guess what? After 2001, small caps outperformed large caps by like 87% over the next decade. I mean, I'm just saying, right? History may not repeat, but, you know. And here's why I think they're in a good position, Alex. Small cap earnings expectations, they've already been cut. Sentiment is bearish. Mega caps, they're facing some new headwinds. Tariffs, regulatory risks, downward earnings revisions. That suggests that they have much more downside risk, while the small caps might be able to take advantage. Conversely, you've got a ton of small cap companies that are domestically focused, less direct tariff exposure, and they stand to benefit if the Fed eases up or if infrastructure spending picks up. And investors? They're still really light in small caps, and any rotation, it could spur some outsized gains. So there's a great potential opportunity, if a risky one.
And Alex, I would just also add, don't forget to consider emerging markets here. They obviously carry risks, but they can give some pretty good upside as well. I mean, some of these countries benefit from commodity strength and they're less directly targeted by these tariffs, right? Also, many EM central banks, they started fighting inflation earlier, and some of them, they're actually easing policy now. And so, valuations in EM equities, way lower than US. I would say a small percentage of those.
Very insightful. Thanks, Adrian and Marcus. Up next, stay tuned. Fed crossroads ahead. All right, so that really sets the stage for what the Fed might do. Jake in the comments asked if the Fed will step in. What do you think, Adrian?
Well, Alex, the Fed's in a tricky spot. I mean, these tariffs, they create this weird mix, slower growth and higher inflation. So, markets are all over the place trying to guess if we're going to see rate cuts or some other kind of intervention. Right now, markets are putting some pretty decent odds on rate cuts later in 2025. But man, those odds are jumping around with every data release. I'd say the most likely scenario is a late 2025 rate cut cycle. If inflation starts to chill out and growth really slows down, I'd also say that for this coming year, we're still likely going to see the Fed hold steady. I'm seeing lots of analysts say that. But the new tariffs, they put the Fed in a bind. Slower growth and higher near-term inflation, right? So it limits their flexibility to cut rates quickly.
Right, and to actually cut rates, they need to be pretty confident that inflation is heading down and staying down. And tariffs, they're a temporary inflationary shock. I think the only way the Fed actually intervenes is if the economy starts to deteriorate sharply, like we see consumer spending just tanking or unemployment spiking. Then the Fed would likely prioritize growth and financial stability, even if inflation is a little above target. I don't think that's too likely, though. It's a tail risk scenario. So with all of that being said, I have a couple of suggestions for how investors should consider adjusting their portfolios, assuming for the moment that they are in for the long haul. If one believes that rate cuts will come by the end of 2025, I would suggest equities and tariff-sensitive stocks. Conversely, if one believes, like the Fed, that the rates will hold, then I would suggest considering to keep a stable portfolio and perhaps consider bonds.
Great stuff, guys. Thanks, Adrian and Marcus. Always great to have both of your insights on NewsNectar. So it's a lot to unpack and to keep an eye on. These are definitely things that are developing, even as we speak. Thanks, Adrian and Marcus, for breaking that down. Hopefully everyone listening feels a little bit more prepared to navigate these tricky times. That's all the time we have for this episode of NewsNectar. If you found this discussion useful, please like, subscribe, and leave a comment with any questions or thoughts you have.
Absolutely.
Thanks, everyone.
And be sure to tune in next week, when we'll be discussing the latest advancements in AI and their potential impact on the job market. See you then.